this podcast, I'm going to look at capital and revenue expenditure and receipts, and it's aimed at both IGCSE accounting and at AS accounting. Capital expenditure is purchase of non-current assets by a business. And one of the key things about this one and getting it right, we need to be able to classify correctly. Capital expenditure initially has no impact on profit. It affects the statement of financial position only because assets would increase and either the asset of cash would decrease or there would be a liability be created. And they all appear in the statement of financial position. It would do indirectly because the decline in the value of non-current assets gets recorded as an expense of depreciation over the course of the ownership of the asset. Okay, but initially it should not go into the income statement. If it does, it will mean the profit is too low. It would include any one-off costs of getting an asset ready for use. So, for example, painting a new building is part of the cost of getting it ready for use, and therefore that should be included as part of the cost of that building. Also, things like carriage of some machinery that you bought to a factory, or the installation costs, even if done by your own workers, are part of the costs of getting that machinery ready to use by the business and are included in the capital expenditure. Additionally, as well, improvements but not repairs of non-current assets are capital expenditure. So if I bought an office and then I decided to add air conditioning, that is clearly improving the offices, and therefore I would include that cost as part of the value of the building that I have purchased. Revenue expenditure is money spent on everyday running costs. Okay, that does affect our profit because it appears in the expenses section of the income statement, or it would appear as part of your purchases of goods for resale and therefore in the cost of sales calculation. Indirectly, it will affect the statement of financial position, but that's because expenses reduce profit and a lower profit reduces the owner's equity or capital. It would include repairs to non-current assets. So, for example, going back to the example of the building where we painted it when we first made the building or purchased the building, okay, the cost 3 or 4 years later of repainting that building would then be a repair cost, and therefore it would be an expense and not capital. Got a simple example here. I'll pause once we've gone through it so you can have a go at classifying things. But we've got a lorry purchase for 50,000. That would be capital expenditure. A license plate for $500. That's a plate that goes on the front of a lorry. Have a think about that one. As part of the purchase price, there was a full tank of fuel for $50. There was also insurance provided with a value of $200, and the company employed a sign writer to add the company logo on the side of the truck for $1,000. So for the last four, have a quick think about where you would put each one. Okay, vehicles, I said already, that's clearly capital expenditure. It's a non-current asset. The license plate is a one-off cost. In most countries, you buy a license plate and that stays with the vehicle for the vehicle's life. So that is capital expenditure. And the logo, even if we pay for that separately from the purchase from the garage, that is still improving the vehicle for use by the company and therefore capital expenditure. Fuel, revenue, obviously businesses, if they're running lorries, would normally refuel them every day. And insurance is normally an annual thing, and therefore the insurance would be renewed every year, and therefore it's clearly revenue. Okay, some quick rules. If we include capital expenditure as revenue expenditure, the profit will be understated because we're going to need to reduce our expenses to increase the profit. We're going to credit the expense because it shouldn't be there. That will make it smaller. The expenses get smaller, and when we correct it, the profit will get bigger. Revenue expenditure classified as capital expenditure is obviously the opposite way around, but we should have included, for example, some of the cost of our vehicles as expenses. That will increase the expenses in the business and it will reduce the profit when we adjust for that. And therefore, the profit before the adjustment has been overstated. Less common, but you still need to know about it, is capital and revenue receipts. Capital receipts is money received, I should say, on long-term benefit to a business. That would include the money coming in from the sale of non-current assets, any long-term loans a business takes out, any capital introduced, and it will affect the statement of financial position and not profit. So, for example, if the owner introduced more capital, that would increase the asset of having cash in the business, and it would also increase the amount of capital, both of which would appear in the statement of financial position. Revenue receipts is just the money received from normal business activities. Sales of goods and services, so that would include additional things maybe like rent received if part of a premises was rented out. And revenue receipts, quite clearly, they are going to increase profit and indirectly they will increase capital. So they will have an effect on the statement of financial position, but it's an indirect effect. The main impact is on the income statement. Right, thank you very much for your time and patience. Hope this was of some use. I've posted some questions for my students. If you get any problems, obviously email me, or if we're still locked down, you can always call me at the times when you know I'm normally online. Thank you very much. Goodbye.